Let's take a look at some charts on ETH from this week's article on Brave New Coin. So ETH is handedly second by market cap, if you believe in market cap as a metric. I don't see Tether overtaking it anytime soon, but that would be an interesting event should it ever happen, because most of Tether is currently on Ethereum as ERC20 Tether, 60% at least, and most of the Tether transactions occur on Ethereum. Tether transactions on Ethereum account for 21% of all of the Ethereum transactions currently. So it's always interesting that Tether uses ETH as a vehicle, as its parasitic host for transactions, and ETH's reward is increased fees and sort of transactions, I guess. XRP once had a chance at flipping ETH, but that's looking like a distant memory at this point and probably won't happen ever, based on market cap. If we start with the fun stuff, hash rate and difficulty for ETH. So they've had a series of massive difficulty adjustments from baked in protocol related increases in difficulty, known as an ice age. These were supposed to promote ETH 2.0. So they were supposed to purposefully kick miners, proof of work miners, off the chain to promote proof of stake. And so far, the ETH 2.0 transition, even the beginning of it, hasn't happened. There are no firm dates. Earlier this year, there was a date floated of between June and July. We're now in July and don't have a date. Now I'm hearing 2021 be floated as a date for the ETH Phase 0 transition to ETH 2.0. So there's really no firm anything right now. Yes, there's a 32 ETH validator requirement being floated, but until this is set in stone on the protocol, literally anything can change. And even after that, stuff can change because that's just how ETH rolls. And so this ice age was apparently forgotten about, and they had to re-hard fork. This was 2 hard forks here to remove that ice age. So to me, they're kind of flying by the seat of their pants as an observer, but that's kind of what you get with decentralized development, I think. At least it's par for the course, certainly. So hash rate and difficulty are up since earlier this year. That's bullish on it's bullish for mining, because if hash rate is up, network security is improved, and most likely mining profitability is supporting this excess increase in hash rate. It hasn't eclipsed even mid-2019 yet. But the other part about this is as soon as Phase 0 begins to happen for ETH 2.0, that's the beginning of the end for proof of work. So you're not going to scale up your mining operation knowing that the Grim Reaper known as ETH 2.0 is going to come and destroy and brick all your machines. So you're either mining what you can now, not mining at all, or mining what you can now and then switching to ETC, depending on mining profitability, because that's the only other chain that I'm aware of that you can mine the ETH algorithm on. So it's kind of a hot mess. If we look at ASICs though, they are in heavy profitability here. This is at 4 cents per kilowatt hour, which is probably about right for most of the large scale operations, if not a little higher than what they pay for electricity. And there's just no chance that, especially with fees the way they are on ETH right now, miners are making fat bank. If we look at block times and issuance on the fill here, issuance has continued to decline since January 2020. You can see each of these drops in issuance was ice age related. Also semi-agreeing on reducing issuance related in the community. So issuance is still like 4.5%, and it was up between 7 and 8% 2018, early 2019. And I was thinking about this yesterday. We have all this activity on DeFi, we have all this activity on chain, we have all this ancillary lockup and buying from Grayscale ETH product, but yet price has kind of been sideways over the past year plus at this point. And to me, I think ETH is still grappling with the inflation since 2018. Block time's at an all-time high, which is good because there's like 125,000 pending transactions on any given day. Gas limits were raised 25% again in June, and the ceiling is being hit pretty much day over day, day after day. So as this gas ceiling gets hit, fees should continue to increase because that just says demand cannot be quenched by block times. So block space gets more and more expensive and fees go up, which is a good problem. Don't get me wrong. Definitely a good problem. Rather see insane activity than no activity. Fee issues also lead to governance issues, which lead to people with skin in the game taking a serious stance on governance. And all that is bullish at the end of the day. Just look at what happened with SegWit for BTC. These are the ETH transactions, Tether transactions, and the Omni Tether transactions. And you can see since mid-2019, ETH transactions just took off. These transactions here were likely Plus Token Ponzi related, if not directly related to Plus Token, sort of adjacent to Plus Token in that they were on Huobi or Binance or wherever. I don't have any hard proof on that, but that's speculation based on chain analysis and timing. Since February 2020, though, something else fierce is happening clearly. It seems like Tether ETH, because of the migrations from Omni especially, and just general exchange adoption of sending Tether multiple ways, on multiple chains, has allowed these ETH Tether transactions to just reach crazy levels. And this is bullish for Tether. It's bullish for ETH if you are looking at it from a utility perspective. It's hard to say how bullish this is long-term for ETH, because if you look at Omni Tether, Omni supported all these Tether transactions, but Omni, the chain, price-wise, didn't do anything really. So it's really hard to say, yes, we have all these Tether transactions on ETH, but is it going to really matter at the end of the day for the price? That remains to be seen. If we look at a full node for ETH, it is approaching 5 terabytes for a full node. This is an actual full node. All transactions that have ever existed on all dApps, everything. So this is going to become an increasingly problematic issue, not only for storage, for the regular average person. 5 terabytes even these days isn't like terribly expensive, hard drive wise, but it's not cheap. And the other issue is just syncing your node and the time it takes to sync the node. So all this leads to issues of centralization and hosting nodes on cloud services like Infura or Amazon Web Services, that sort of thing. And as we see more DeFi activity or more dApp activity on ETH, the hard drive requirement will increase, the syncing requirements will get longer. So that all just leads to centralization issues. Basically removes the average user from being a participant in the full node environment. Now, a lot of the ETH people will tell you, you don't need a full node. You can get I guess what I'd consider a partial node where it doesn't have the entire history, but it can call certain parts of the history from other nodes, like data partitioning or sharding is even related to that. So it gets murky when we talk about definitions of full node for crypto related ledgers. This is transactions per day and average fees on the fill here. And you can see fees are up considerably since April on average. I mean, nothing crazy on a single transaction. Okay, so it's like what, 65 cents, something like that, 60 cents, which sounds fine, right? But when you interact with smart contracts on ETH and you do multiple smart contract related transactions at a time, fees get in the $10 to $20 range at that point. And this spike here was the 2 transactions that were sent with a $2.6 billion transaction fee, possibly related to a white hat hack of a Ponzi scheme. Again, I don't have any hard proof of that, but that's speculation. Transactions per day have just absolutely skyrocketed since January, and this follows Tether pretty well. So 21% of the transactions here are Tether related, but all in all, transactions on ETH have increased to near all-time highs. And to me, there's a divergence in price because, again, you're seeing all this utility, all this on-chain activity, and price is just sideways, right? For 2 years, 1.5 years, just doesn't care. So to me, it's a bullish divergence because without activity on a chain, there's no fundamental underlying value. So there's some weirdness going on here for me, price-wise. And I think that's related to inflation. So when this demand eventually catches up with inflation, we'll see price rise, I think, which may mean, we might need several multiples of transactions per day, sustained activity to actually see a move in price, which is sad and interesting. Fees are nowhere near where they were at similar transactions per day levels. So, we're above 1 million transactions here, which hasn't ever happened other than 2017, 2018. And fees are obviously not $3 on average for any given normal transaction. So that says that some scaling changes have worked for fees. This is the gas limit I was talking about. I think of it as a block size limit, which isn't correct, but that's just how my brain rationalizes it. So you can see where the miners or the community voted on increases in gas limits, and you can see where it just hits the constant ceiling day over day. That's when you start to see a rapid increase in pending transactions, because you just can't fit anything more in a block, right? Like, that's just what it is. And even though block times are 13 seconds, they're consistently full or expensive. So they either don't get sent or they're wait to be sent at a time when fees are less competitive or cheaper, that sort of thing. We're not seeing day over day gas limit hitting the ceiling, but it's approaching. The way transactions per day are rising, definitely approaching. If we look at NVT, inverse metric of economic utility, here in the line, and monthly active addresses in the fill here. Monthly active addresses, similar to transactions per day, have only ever been this high, 2017, 2018 period. Extremely bullish. You can see there's a lag time here because it's the monthly average. So this peaked kind of early January versus transactions per day on a weekly average peaking somewhere in like December, January 1st region. But this all just says bullish divergence on price to me, because more and more people are using Ethereum. More and more people need Ethereum to transact with smart contracts, with fees, that sort of thing. So this all should be bullish. If we look at NVT, so it measures on-chain activity versus market cap. And one thing that immediately sticks out to me is this increase, this trend since 2018. And again, I think this is inflation related, because inflation adjusted, I think this would look a lot different. This also doesn't account for DeFi smart contract activity. This is just ETH specific chain activity. So if you included DeFi stuff, this would probably look like an all-time low. And it's good to see NVT dropping instead of rising. Inflection points tend to be bullish when they're falling, bearish when they're rising. ICOs have done essentially nothing. Over the past 3 months, there might be one or two here and there, but really nothing to add to this chart. I just like to check in on it every month, see what's happening with it. But Ethereum's essentially traded its ICOs and ICO treasuries for DeFi. If we look at the treasuries, treasury holdings have dropped about 3.5 million since 2018. ETH, this is an ETH here. In recent months, not really much activity, selling activity. This was at the time the largest ICO treasury, Digix DAO, that voted on redistributing the ETH to its holders, which was probably the smart decision. I think at the time, the ICO was worth more than the project was worth. So the ICO treasury was worth more than the project was worth. But it's good to see this come down. You don't want to see supply glut overhang. This all represented lockup initially, which is great for price, right? But when this starts unwinding and inflation's at 7 to 8%, to me, that's part of why price is where it's at. If we look at the dApps on ETH by volume, Compound is handedly the number one dApp, thanks to things like yield farming or lending. And most of these others are either lending related or exchange related, derivatives related, stablecoin related, scam, probable scam. So all in all, the top 10, top 11, top 15 for ETH has gone from like 100% scams to 20% scams. And volumes have gone way up. Transactions have gone way up. 80% of the dApps listed on dApp Radar have no activity and no transactions, no user volume. So although it might look like ETH has all of the dApps, they certainly have most of them by a wide margin. But when you look at them under the hood, most of them aren't being used at all. ETH locked in DeFi, so just as ICO treasuries have fallen ETH locked in DeFi has increased almost as equally, 3.5 million. So again, it's like we have all this DeFi activity, ICO treasuries are selling, but DeFi activity has kind of taken that place, that role by locking up supply. And there's this other elephant in the room that's 15 million ETH have been created over the past 2 years, where there may not have been a demand to outpace that inflation by demand. Flipping over to technicals, we have Bitfinex long shorts, yearly pivots, VPVR, 50, 200 EMA, volume, and RSI. So right now ETH is above most of the yearly pivot resistance support areas. It certainly has this 300 zone, yearly pivot, and VPVR level to contend with as far as upside resistance. But it also has this VPVR, this yearly pivot, the 200 EMA as support. So it's got to make a decision soon. It's unlikely that we go sideways into 2021. So we're going to climb this ladder one way or the other. The big support's at 136, just from the previous accumulation zones, the previous drops, the previous lows, that sort of thing. Volume has continued to decline since the March 12th drop. Typically that indicates consolidation of some sort and getting ready for the next move. Arguably, this represents a growing bearish divergence. You can see RSI's kind of petered off since mid-May as prices are sort of creeping higher. There's also potential for a cup and handle chart pattern here, which would bring price to 350 plus probably. Another big concern for me on the long side is these ETH longs are at all-time highs, as well as an all-time high in nominal value, notional value. 435 million is what these longs represent in USD. So as it sits, it's more bullish than bearish, certainly. Longs could get squeezed, but the issue with the long squeeze is these longs have gotten in kind of at the lows here, the big chunk of them. So to squeeze these longs, we'd probably have to break the March 12th low, which I don't see happening in the near term. Certainly some of the longs would come off if we dropped to like 188, but I don't see longs really going anywhere on Bitfinex right now. If we look at a Pitchfork for the past year and a half, we get this nice range that sort of hasn't really proven to be validated yet. The Pitchfork started with anchor here, 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 and then that broke down, so now I just moved it here, and that's part of the Pitchfork game. In the beginnings, it's subjective, and you hope it holds. If it doesn't, you adjust it. The purpose of this is to show extreme outliers. If you treat this as an oscillator, overbought, oversold, if you look at the link BTC Pitchfork, textbook example of what you'd expect. The midline represents an area where price wants to continue to return. So right now that's about 285, something like that. So overall, the Pitchfork is saying this blue area is where it expects price to be on any given day if this range holds. And it's kind of right there right now. So it's not like we're way out of any sort of expected midline or something. The Pitchfork looks fine here. It even looks fine down to 133 for ETH. Upside is around 750 right now as far as resistance. If we look at the cloud, everything is bullish but flat on trend. So what you don't want to see is a thick cloud. You don't want to see TK lines flat. You don't want to see a flat lagging span if you're bullish. Although this represents a bullish bias, it doesn't represent strong momentum. I mean, that's kind of obvious where sideways have been for the past few weeks. Nothing's really going on here. If we do get the bearish TK cross, that would tell you to close your longs and wait for the next bullish TK cross to reopen your longs. If not, waiting for this edge-to-edge trade to happen down to 170, 176, something like that, which is possible. Not expected at this point. This doesn't look as dire as the BTC Cloud because the BTC Cloud does have a bearish cross right now. And lastly, if we go to ETH BTC, it is on the top side of all the resistances that matter, basically. This is the 2-day 50 and 200, so it's the 100 and 400 EMA. Hasn't crossed bullish yet, but it will if we stay sideways. It's above the yearly pivot. It's above this key resistance support zone. Next stop is probably 035, 037. Back in the previous range here, back to this VPVR node, back to this yearly pivot. No bull or bear divs on RSI volume per se. I would like to see volume pick up significantly if this starts to make definitive higher highs. So overall, you have a rare event where on-chain activity is mooning and price is kind of doing a bunch of nothing. So something's got to give sooner or later here for ETH.